Hey, so there's a lot of talk in the media right now about the rising interest rates and its impact on real estate. A lot of investors doing something called pencils down, or they're not even underwriting deals. But I think there's a tremendous opportunity in today's market for great deals. And so I want to talk in this video the impact of interest rates on real estate and how you can still find great opportunities in today's market. Hey, what's up? My name is Ellis, Hammond. I'm a full-time multifamily investor. My company is Symphony Capital Group. We purchased just over $100 million of commercial real estate in the last year. And I do these videos because I want to help other real estate entrepreneurs really go and do bigger deals, raise more money and find more deals so that we can partner together. So if you like this content, make sure you leave me a like and subscribe to this channel. But I want to talk about what does the rising interest rates mean for real estate? And more importantly, how can you still find good deals in this market? Well, rising interest rates makes our debt, more expensive essentially, right? So a big portion of buying large commercial real estate deals is leverage, is debt. I mean, it's typically 60 to 70 to potentially even 80% of the purchase price. And probably for the last several years, I think a lot of people have gotten comfortable with kind of 75, even 80% leverage. And in today's environment, as interest rates are going up, this has just caused lenders to become a little bit more fearful. And so what that means is a couple of things. One is we're not seeing as much leverage on deals. So we're under contract right now on a project and we're getting about 65% leverage or loan to cost, meaning our total cost on the project, the lender is giving us about 65% of that cost. There's opportunities in that. I mean, the tough thing is that you got to go raise more money. You need more equity in order to bring to the deal. However, that creates opportunity because that means a lot of investors don't have enough capital or they don't have enough investors in order to go purchase these deals. And so what we're seeing in a competitive market like Dallas is there are less buyers. There's less buyers in the market because they can't go raise the money that they need in order to go purchase the same size deal that they were able to purchase 6 months ago. So I think there's tremendous opportunity if you have access to capital right now. For those who have access to capital, know where to go find capital. It's a tremendous time to go break into a market because there's just less competition. And with less competition, you can get more attractive prices. The seller has less offers on the table, and so there's more negotiating for you as the buyer. I think the other thing to consider in this rising interest rate environment is that we also have a rising inflation environment. Right? And so there's a ton of talk about interest rates, but remember, inflation is still a massive factor in today's market. And so as interest rates are going up, realize so are rental rates, right? So are salaries, right? There's a lot of forces increasing the cost of living too. So yes, your debt is getting more expensive, but if you're in markets like Dallas, Houston, Austin, Florida markets, for example, your real estate, your rental rates, are also going up. And so yeah, your costs might be getting more expensive, but your rents, I mean, it's very likely in markets like Texas and markets like Florida that your rents today are going to be higher 5 years from now. The other thing to consider though is that the Fed will eventually slash interest rates, right? So there's, I think on average, history shows us that between the first interest rate hike and the next interest rate cut, meaning when the Fed starts to slash interest rates, it takes about 3 years. So if you can weather that 3-year storm, right? Like you buy a deal today and you spend the next 2 or 3 years doing your value add business plan, you're increasing rents, you're stabilizing the apartment building, and then you're ready for the Fed to start slashing rates, you can still be just fine. The important thing to note in all of this is that you want to be buying good real estate deals that currently cash flow, that are projecting higher interest rates, probably at least in the 6 to 7% interest rate, can still cover all of your debt and expenses, and you have the ability over the next 2 to 3 years through your value add business model is to increase cash flow. And if you can do those things, you can find those type of deals, make the numbers work on the front end, and you can increase revenue over the next 2 to 3 years, there's still incredible opportunities. I think one of the best times, especially for early real estate entrepreneurs, to break into these markets. Because 6, 8, 12 months ago, there were so many buyers, there were so many people on deals that it made it almost impossible, nearly impossible for a new real estate investor to break into competitive markets. So if you're still bullish, if you still have conviction on your real estate market, you can find good deals that cash flow today, and you have the ability to increase cash flow over the next 2 to 3 years, I think it makes a lot of sense to keep buying in today's real estate market. Hey, let me know if you're a buyer or what you think about today's real estate market. Leave me a comment below. Love to hear your thoughts. Think wealthy, friends. Cheers.